thank you for joining us today in person and online for the March Aitken Partners Breakfast Seminar, the new property tax era. 2026 means for you! Oh, fantastic. My name's Ric Birkett. I'm a principal lawyer in the Commercial and Property Department at Aitken Partners, and I will be your host this morning on Whose Tax Is It Anyway? Here's the way the game works. I'm going to ask our contestants random questions that they've never heard and have no idea are coming at all. If they answer correctly, they get 1 point. If they answer incorrectly, they lose all their credibility. Probably miss their job, so they get laughed at, ridiculed, and mercilessly. Our questions today will focus on the evolving property tax landscape in Victoria. Ooh, I hear you say. The expansion of the Vacant Residential Land Tax. You may hear that referred to throughout as the VRLT. So if you hear those letters, it means Vacant Residential Land Tax. And when you hear those letters, you've all got to do a Mexican way. That's what the audience participation card is. Then we're going to talk about the rollout of the Commercial and Industrial Property Tax Reform Act. It gets better. Then we're going to do assessments, valuations, and the objection process. Now, if time permits, at the end, even the members of the audience may get a chance to ask some questions. And if people at home playing from home want to ask any questions, you can tap away and they'll be relayed in the room. We'll make sure we can get through all of our content before that. So who are our contestants today? Ladies and gentlemen, she's an equity principal and team leader of the property and commercial law teams at Aitken Partners. She advises clients on complex property transactions, developments and structuring matters, and regularly assists property owners, developers and investors with GST, land tax and stamp duty issues arising in property dealings, including compliance, objections and land tax assessments. Please welcome the pantheonic pinnacle of property law, Julie Maxfield! Our second contestant today has travelled all the way from the 40th floor. He's a highly experienced property valuer with more than 30 years in the Victorian property market and extensive expertise in rating and taxation valuations or taxing valuations. He's worked closely with Aitken Partners on a number of land tax and rating objections, including matters requiring active litigation. He's a fellow of the Australian Property Institute and accredited expert witness valuer, and regularly assists property owners and legal teams with land tax and council rating objections, and has represented clients in more than 800 objection and tribunal matters. He's the veritable Viscount of Valuations, Chris Nicodimou! And finally, ladies and gentlemen, he's a special counsel at Aitken Partners and has almost 30 years' experience advising individuals, businesses and corporate groups on federal and state taxation matters. His practice includes land tax and duty advice in complex property and commercial transactions, helping clients navigate structuring issues and dealing with revenue authority requirements. He's the tenacious titan of tax. It's Marco Saccotelli! So our first category today, Vacant Residential Land Tax Expansion, Geographic Reach, Exemptions and Audit Risk. Our first question to Marco. Marco, what is Vacant Residential Land Tax?
Well, to start with, it's not a land tax because it's based on capital improvement.
Sorry, Marco, are you criticising all questions there? Because
Criticising the draft.
Oh, sorry.
It should be called VRT. So it came out in 2018, but it was limited to certain Melbourne LGAs. And essentially, if you had an extra house that you were using, occasionally, or a property that you are not really renting out much, we make you short saying it. If it's not used for more than 6 months by a tenant or someone who has a commission to be there, a licensed person under a license, even a family member who's paying a small license fee, then it's considered vacant. So, of course, it's a question of fact to degree records. So that was around from 2018 and it's now being expanded Victoria-wide in terms of existing properties. And then in Melbourne, it's actually now being extended to growth areas where you have undeveloped land, which is in a residential zone, and you don't do anything with it for 5 years. So in short, 1% CIV first year. If it goes through to 3 years, it caps out at 3%. So it's market value, not the land value. So that can add up if people are unaware of it.
The second question, Nico, what is CIV?
Capital improved value is, if you look on your rate certificate, you'll see they had an idea of what the market value of your property is. So it's with the improvements on top of the land. It's the total market value.
And what is it if you don't look at the improvements, Marco?
It's UCV. So that's generally what we've had for a long time, since the 1940s. Look at these, is land tax. So that's an improved capital value.
So you'll hear both of those terms throughout today if you're not aware of it. Okay. Well, Marco, I have another question for you, but you may have answered it already, so we might move on to Julie. Are you ready, Julie? What are the key exemptions available, and what does the State Revenue Office in Victoria typically expect to see when those exemptions are claimed?
Can I own it?
You can.
Just kidding.
So as long as it's not me.
I guess key exemptions. Firstly, it's important to note that it doesn't apply to commercial residential purposes. It's vacant residential land tax. Also excluded from the operation of that are residential aged care facilities, retirement villages, supported residential services, and also land that's in alpine areas or dinner plain. So they're specifically excluded. In terms of exemptions, the main one is the holiday home exemption, which is where you have to use the property for 4 weeks in a calendar year, and that can be yourself or your close relatives. So close relatives would include your parents, siblings, grandchildren, grandparents, etc. But it's important to note that the 4 weeks does not need to be 4 weeks in a row. It can be 2 weeks here, 2 weeks there, and it also doesn't need to be 4 weeks by the same person. So it can be any of those people. So the people that own the property, also the close relatives can make up the 4 weeks. In terms of what the SRO looks at, it has to be genuine. It also has to be, they look at how far it is from your home. So is it 5 hours away? Is it 2 hours away? They look at when and where you're using it, in terms of are you using it on the weekends? They look at a range of other factors too, in terms of how they audit, which we'll talk about shortly, but basically utilities, they look at whether there's been a recent transfer, which might obviously indicate good tax planning, but it also might indicate, I use the word avoidance, but you know what I mean, that will draw scrutiny. And that's about it at the moment.
And it was interesting that you talked about distance. I recall a client coming in who purchased the property just next door, but was leaving it vacant for a period and asked me whether it could be called their holiday house. The advice was quick.
So that's the holiday house exemption. There's other exemptions, obviously. There is an exemption for deceased estates, which allows, after the deceased person passes away, it can be eligible for the exemption under a different ownership of an individual. So it can apply if a deceased owner's relative has a PPR in Australia, uses the holiday note for that 4-week period in the previous calendar year, and that will continue for the earlier of 3 years, or when the property vests in another person's or on sale. There is also exemptions for corporations and trustees. So properties held by companies or trusts, which generally relate to similar circumstances to the holiday home exemption, but relate to the occupation by a majority shareholder or entitled beneficiary. There is obviously, if a property changes ownership in the previous calendar year, so there's a sale in 2025 and it was vacant in that year, you won't be subject to vacant residential land tax in 2026. It will start the next year if it has been vacant for that 6-month period. Land that is contiguous to a holiday home, So that's generally we see, a tennis court that's on a separate title or a swimming pool if you're lucky enough. Those things are also included in the exemptions if it is reasonably enhances the use and value of the holiday home. Land such as, I know we've got some developers in the room, so change of use, for instance, that wasn't previously residential land, so it was commercial land and vacant. If that becomes residential land, that's also exempt for the first year if it's been vacant as commercial land. Land that is incapable of residential development. So what we look at there is there, contamination issues? Are there covenants or restrictions on that land that prevent it being used for residential purposes? There is an exemption for that as well. And there's also an exemption if you're renovating a home or you're absent. That's got to be genuine. So a genuine renovation. And it means that the house has to be inhabitable. So you can't sort of just say, oh, I changed, the back door and the windows and claim the exemption on that basis. But that's also another exemption from the Vacant Residential Land Tax. So a lot going on there.
Heaps of exemptions.
I'm pretty sure I just went to bully Troy.
Yeah, well done. Well done. 1 point. Marco, just taking you back to the second question that I didn't ask you and the second part of that question that you didn't know about, where are you seeing people being caught out at the moment with vacant residential land tax?
Oh, I think it's just that people are not aware of it. I mean, a lot of people don't have a trusted advisor who keeps them up to date all the time. So also in deceased estates where it's been a long period, I've had that come up a few times. But yeah, I think it's just ignorance of the law, which unfortunately with the SRO or in any area of the law is not makes it'll be pleaded, but it's not
Julie, we're seeing increased scrutiny or audit activity from the SRO since the expansion of the VRLT.
I don't think it'll be a surprise to anyone that the State Revenue Office is auditing more, scrutinising more, given the state debt. They actually released a article on their website basically entitled Compliance 25-26. So, and they've said what they're looking at. I think in terms of vacant residential land tax, they're looking at two main things. One is people that are claiming the holiday home exemption when it's not their holiday home. Things that they look at in that regard, utilities bills, they use a wide range of data matching programs. So ATO, banks, you name it, they have access to it basically, I would say. They don't publicise that they do, but I think it's commonly known that they're the things they're looking at. Electoral roll searches, lag titles, things like that. They also do look at, my understanding is Airbnb. So if you've got your property listed on Airbnb and it's booked out, for 6 months or something, I think that might raise a bit of an alarm. They look at, obviously, tip-offs. If someone rings up, they'll look into that. They look at the residential tenancies bond register that they have access to. So if you've lodged, a bond, you're obviously not using that property as your holiday home, I wouldn't have thought. The other thing that they look at is vacant residential properties where there's been a failure to make a notification. So notifications are required by the 15th of February each year. If you obviously get your land tax assessment and you don't correct the fact that your property is vacant, that's another trigger for the SRA to start looking into it. And I guess it won't come as a surprise that the things that they are looking at are high value properties, recent transfers, things where they can, I guess, get the most amount of tax.
Marco, how does the vacant residential land tax interact with short-term letting, particularly given that you'll have periods of vacancy and then periods of usage?
Yeah, so the short stay levy is, you're either on a platform or you're doing it yourself, and that's 7.5% of the gross fee
that you charge for PEC to use. So that's for up to 28 days. That's what a short stay is. So how it all interacts is, let's look at an example. If you have a property in a family trust, it'll be subject to the surcharge rates of land tax. If you are short stay messing it, that you don't let it out in a 12-month period for at least 185 days, you'll have short stay levy. Sorry, it'll be considered vacant because it hasn't been used more than 6 months. So you would have surcharge land tax, short stay levy, and vacant residential land tax. And I don't know if it's got a car park, not congestion levy, mental health levy. You've got 4 or 5 toilets called toilet tax.
Fantastic. That's something to look forward to for all of us, isn't it? We might move on to our next category because I'm conscious of the time. And Chris, a few questions for you, mainly around land tax objections, structuring and dispute strategy. So, Chris, in basic terms, what is an objection and who can lodge one?
An objection, when we're considering the land tax notice, can be a couple of items.
This, I might get you to hold that microphone slightly close.
There's a couple of items that you can object to on your land tax notice. The principle being that the value on there, what's called the taxable value, which is the site value, used to be an objection around that it was too high. It changed that, and now you object to the fact that it's incorrect. Essentially, the whole raft of changes have occurred from about early last year, and so the basis is that there's challenges to the level of value that's been assessed on that notice, and that site value that determines the land tax payable is prepared by Valuer General of Victoria by their contract valuers every January of every year. So as well as objecting to the ground that the value on there is incorrect, you can also object to, in a bit more complicated circumstances, the assessment, if it's broken up into different parts, i.e. the apportionment, or the interests are not correctly noted on the land tax notice correctly, they're fairly underground. But the main ground for objection, from the point of view of really reducing your land tax payable, is that the site value or taxable value is too high or excessive or incorrect.
And how long have you got?
Well, this is very important because every notice, from the point of view of a rate notice or a land tax notice that you receive, you must lodge an objection within 60 days of the issue date. Some say that the date that's been received, but strictly speaking, many circumstances, you've got to go off the issue date that's on those notices. And a lot of these objections used to be done manually. They're now on the SRO. I've got a portal, which is the best way to lodge it, as well as through rate bases, through the Valuer General's office also, you lodge it online.
If you missed the 60-day objection?
Unfortunately, if you miss a 60-day objection, in my experience, I'm yet to see an explanation or excuse as to how it could be included as a valid objection. Just be mindful that if the property is tenanted also, then effectively an objection can be to or by the party who's aggrieved. Now, an aggrieved party is somebody who has to pay that bill. So, for instance, in the case of a tenant, if they are required to pay the bill as per the lease, then that objection timeframe can in fact extend up to 4 months.
And with the objection periods for the assessments that have been released early this year, people will be very fast approaching that 60 days. What should property owners be reviewing now?
That's right, Rick. So most of the notices that I've seen, the land tax notices were issued on the 30th of January.
with this year, and 60 days effectively the 31st of March. So you really need to have that objection in before that date. Now, what you should be, I guess, looking at, sometimes site value, because it's not straightforward, i.e. what if market value of the land, because as Mondays indicated, it's an unimproved value, it can get quite complex. So a lot of the time it would be recommended to look at the site value in your land tax notice, but be mindful that it may not necessarily actually reflect market value of the land. Importantly, please be aware that site value is assessed irrespective of the improvements on the land. Okay, so it's a hypothetical assessment of value, and it assumes the land is vacant with no improvements to the land. And so the starting point would be vacant land sales as a comparison. But in complex matters, there can be other adjustments to that site value also. It would be good, I guess, for first-timers or even in looking at whether it's worth objecting to the site value. Look at your rate notice. Your rate notice will have 3 values on it. One would be the capital improved value, as Mondays explains what that is, being the land and the buildings, and the second value will be the site value, the only accrued value. If you're looking at those 2 numbers, most people are very familiar with the market value of the property. That is truly the market value, assuming it would be for sale. And the site value, as I've indicated, is something slightly different. So that gives you a little bit of a guide as to whether something's right or not. Here's those 2 numbers. The third number, which is relevant for rates in some inner municipalities, is called the net annual value, which is effectively the net rental value. But hopefully, if you just look at rate notice, it should give you some idea as to the levels of value and whether your site value, your land tax notice, is reasonable or not.
And a bit of a bonus question here, Chris, leaning, you didn't know this was coming, but in terms of objections, can you object if you fail to seek an exemption, but you believe the property should be subject to an exemption? Question, right? Do you want me to answer that? Well, I figured it was a big item, but Julie, why don't you answer that question?
So if you get your land tax assessment and there's a taxable property, so we're seeing a lot of, as part of the compliance enforcement, we see a lot of primary production, for example, properties been primary production for 100 years, and they're now getting assessments because the SRO says, well, you're not using that for primary production. So you can seek an exemption, but you must do that within the 60-day period. So when you get you can do that via the portal, as Chris said, or you can do it online, or obviously in writing with substantiating material.
Yep. And one thing to keep in mind though is that seeking the exemption before it's issued, if you're successful, makes life a lot easier than having to make an objection after. So certainly sitting around waiting for your assessment to then seek your exemption ain't great.
Particularly so where you have to pay the tax until you get to the exemption. So for a primary producer that's, asset rich, cash poor, and you're getting assessed on, millions of dollars worth of a farm, that's a lot of land tax that you've got to find and pay. So it's important to make sure your house is in order and try and get that in ASAP.
Just as an example, I've got a client who is a charity and have sought a charitable exemption, and the SROs so far are 18 months considering that. They've had to pay land tax for 2 years while they're waiting for that objection to be sorted out. Their circumstances were such that they couldn't have sought the exemption earlier, but that gives you an idea that it's much better to get an exemption and get the assessment and object.
And if I just add to that, I do get asked still, should we still pay, even though we've lodged an objection or seek proof of exemption, should we still be paying the tax or the rates? Absolutely, you should still be paying that. and if you're successful in the outcome, then you would generally get a refund or credit.
And what sort of evidence typically, Chris, do you need to provide if you go to object to a land tax assessment, particularly around value?
So objecting to a site value in Victoria, each state can vary in terms of the process, but initially to lodge the objection, there are minimum threshold values, but initially to lodge the objection, you do not need to supply evidence in your objection form or online submission. It is essentially up to the Bailier General to explain and outline the basis on which they've assessed the value of your property, and then you have within 30 days of receiving their correspondence, 30 days to respond, and that's when you will need comparable evidence to support your argument. It's not an argument to say, oh, my land tax, now the land tax I paid is increased by 20 or 30%. The ground and the basis for the argument is that my site value has gone up, and I'm objecting to the site value of view of my sales evidence to support why it should be something less.
Is there value in getting your own valuation done on site properly by expert valuers such as yourself?
That certainly is a reasonable price, depending on the type of property, of course. These matters have become a little more complex in the last few years. And so there are also a number of precedent case law that occurred that have shown that an objector without expert evidence can be very challenged, because you would have to appreciate there's the different process we'll get to, but lodging an objection basically is a valuation issue. You're arguing effectively about the value of the property being incorrect, and so unless you're very well informed about the marketplace and the property that you're not happy with the value, then absolutely it would be very recommended to get a valuer to look into it. I see a lot of clients sometimes might get other experts or professions involved, but effectively, if it's a valuation issue, then best to get a valuer involved.
Terrific. One other thing to say on that is, if you're going through an objection process, keep an eye on the emails and letters you get from the SRO. We are seeing more and more an email that comes and says, right, thanks for all the stuff you've given us. We would like this particular piece of information. By the way, if you don't give it to us within 14 days, we will make a determination based on what we have or treat your application as we thought. We in particular had one where, again, there was a huge delay, heard nothing from the SRO, then got an email saying that we want all these things in 14 days. There you can go back and apply for exemptions and so forth, but just keep an eye, read the fine print, because again, far more aggressive about saying, we've done our bit, you didn't do your bit, you'll have to take the VCAT if you want to keep this thing going. So, speaking of VCAT, great segue, Ric. Chris, if a land tax objection is unsuccessful, what option does a property owner have to challenge the decision of the Victorian Civil and Administrative Tribunal?
So if you've run through the objection process, you've lodged it online, you've got some correspondence back from the Valuer General or the contract valuer, and you've had a meeting, you should be able to ask for a meeting. You have a reasonable opportunity, well, you must be given a reasonable opportunity to consider your objection application, and please insist that you have the right to have it explained, not just in writing, but if you want face to face. And if you go through that process and you're not happy with the outcome, and the valuer, contract value of the Valuer General issues what's called a notice of disallowance, and you're not happy with that, then you have 30 days to apply to VCAT for review that decision. Okay, so that application for review again is filed online at VCAT, and then it sort of comes into a formal process of review, and now the matter starts to get obviously a lot more serious. In this case, it is highly recommended to involve legal representation and certainly evaluation expertise. And so you lodge that objection application online within 30 days, and then you will receive correspondence from the tribunal about the timetable, setting that matter forward as to how that will proceed. Now, as to whether it is reasonable or not, when should you lodge an appeal? Keep in mind that these matters are not as straightforward as they used to be. Involving different expertise can be quite costly. Typically, the site value and land tax notices, every $1 million in site value is equivalent to about $26,500 in land tax. Okay, so if you've got a high value property and you're suggesting a couple of $1 million overvalued, then $2 million, roughly, 56 or thereabouts, $1,000 potential. So you start to work out where is it worthwhile or viable to run these matters, given what potentially the cost might be involved.
But it is interesting. Obviously, you've got to be commercial. You might have the best case in the world, but you've got to be commercial and sensible about whether you ramp up. But again, what we're seeing, particularly with now a lot of residential properties, I'll call it the lower, cheaper end of the market, getting fairly healthy valuations. And I think that there's a lot more courage in the SRO to put a high number on those, because the cost and difficulty of going through that VCAT appeal process sometimes can outweigh the extra tax, which is ain't great for justice. But was with people with small residential units, more and more are saying, well, yeah, look at this valuation. I'm not going to be able to sell it for that, but the cost of being able to challenge it is also something that's for difficult. In terms of valuation evidence in VCAT, how important is expert evidence?
Well, keep in mind that once you make that application to VCAT, you are challenging the values that have been put forward compared by Value General, their contract values. They will appear in VCAT with their legal representative, and they will also appear with a valuer. There's a performed valuation or somebody who's the review with it. So already you're dealing with strong defence potentially or offence and of the value that you're challenging. So if you appear there on your own, the room's full of all these suited people from the government and legal representation, then you really need to, I guess, be prepared for the challenge. Okay, so more so is very important to be prepared with legal representation, valuation representation, because be mindful that we're talking about legal proceedings potentially, and there's an issue of costs. Okay, so if you want to challenge the respondent, Value General, parties about a valuation, then be mindful that there are costs accumulating from the day one. Okay, and although the conduct is all taken into account, just be mindful that if you are unsuccessful in your objection and appeal, there might be a cause to seek costs against you at the end of the day. So important to have the right people in the room representing you, who can best serve your interest in these matters.
Thanks, Chris. And now a bonus question worth 3 points, ladies and gentlemen. Have there been any recent decisions in the High Court that might be of interest in relation to site values and assessments for land tax purposes?
Thank you. 11th of June 2025, the High Court of Australia issued a decision in the matter of WSTI, which relates to a property in St Kilda Road, which had started from an objection, and then the owners were not happy with the outcome, appealed to VCAT. VCAT issued a decision. The Valuer General was not happy with that decision. We went to the Court of Appeal, who issued a decision. Valuer General was not happy with that decision. We went up to the High Court. Now, the High Court issued a decision in June of last year, which is quite significant, has really made significant impact as far as my work goes, and objections in the space go. It can be quite a complex matter, but even though that case dealt with heritage properties, which ultimately ended up talking about how improvements are to be considered. Now, improvements are important because site value is unimproved valuable land. So with regards to heritage properties, the contention currently put forward is that, if the buildings are not there on the land, and that's how you value site value, either the buildings are gone, the improvements are gone, there would have not been any heritage restrictions come into play from the start. So therefore, the site value also reflects the unencumbered value of the land. Now, just appreciate what that means. If you have a site value that's been assessed unencumbered, especially when we're talking about heritage properties, then these site values will be much higher. And this is the critical issue that's currently in a lot of objections that I'm involved in also, and which is currently being pursued through the tribunal and courts.
Thanks. I think you got the 3 points. Well done, Chris. So now we're going to move on to our Super Punch bonus round, where the contestants get to go to the power board and, of course, hopefully pick 3 cases. And by cases, I mean the little ones that open and you say $100,000, not, you don't have to know the law. So we're going to talk about the wonderful Commercial Industrial Property Tax Reform Act, which we've all been very excited about since 2024. Marco, let's start with you. What does the Commercial Industrial Property Tax Reform Act 2024 actually change in Victoria's property tax system?
Just quickly, in South Australia, they removed duty on commercial property. So let's see, Adelaide's trying to get people to buy buildings out. So what's happened in Victoria is they've taken up the Ken Henry idea that we should have a uniform Commonwealth land tax, a bit like GST, with the money going back to the states to fund education and health and everything. So that's what they've done. So what it's going to do is when you'll pay duty if you buy more than 50% of a property after 1 July 2024, and then any transaction after that time will not be subject to any further duty. But when you get to 10 years, a year after 10 years expires, you'll pay 20% extra land tax, CIBT tax. So it's trying to make buildings more attractive, because if you're buying a $150, $200 million, a massive building, and you're a foreign real estate investment trust or a domestic, whatever entity is, syndicate, that's a lot of stamp duty to have to pay. So with these reforms, they've also brought in the ability to have that duty financed by the Treasury Corporation of Victoria. I don't think the interest rates are that good, but you've got that option there to be able to pay off that the initial duty, and you pay the final duty. So it's basically an extra bit of land tax. You're on top of your existing land tax, but then you don't have to pay stamp duty. Then someone buys it in the future.
And what constitutes an entry transaction that drags a property into the system?
Yeah, the rules on this are pretty complicated, but just to boil it down, so you could have a sale where more than 50% of the duty will value. It could be a landholder duty acquisition that's more than 50%. So that's private trusts, private companies, and widely held trusts. So anything that would ordinarily impose duty, but it has to be more than 50%. If it's a minority stake, it doesn't enter into this new system. You see a 10-year period. And of course, it has to be commercial or industrial. So you have to look at the Australian valuation property classification codes that are used in Victoria to see whether you're in, factory, warehouse, manufacturing, commercial, retail, commercial, or all of those areas. So you need those requirements. You need the qualifying land with your AB, PCC codes, and you need to have an acquisition of more than 50%.
So, Julie, you haven't had a question for a while, so let's give you this one. There's a 10-year transition period. How does it work? And when does the new annual tax actually become payable? Is 10 years 10 years, Julie?
It's a very good question, Nick.
Thanks.
So as Marjo said, the 10-year transition period starts when there's an entry transaction on or after 1 July 2024. And during that 10-year period, obviously you pay stamp duty. We would call it one last time, hopefully. Don't know what the government's going to do, obviously. And then there's no stamp duty payable in that next, following on from that. And there's no commercial and industrial property tax paid until 10 years after the entry transaction. So what then happens is, and it's important to know, of course, it's in addition to land tax as well. So it's an extra 1% of the unimproved or the site value. And it starts 10 years after the entry transaction. But essentially, does 10 years mean 10 years, Rick? It starts the next year. So if you have an entry transaction in August, your 10 years is up in, say, August 2036. The annual tax will start the next year, 2027. So you get a little bit of a free kick, but not a lot. I guess what's attractive for purchasers is that there's no stamp duty payable. So especially in that 10-year period, if you sell the property and someone else buys it, they're not paying stamp duty and they're also not paying the tax yet. But they will need to know that tax will be payable 10 years from when it went into the regime. So clock doesn't reset if it's sold in that 10 years. But you might sell it 5 years in, so that next purchaser won't pay duty and they won't be paying the CIPT for another 5 years. So it is important to note that, and that essentially we might say 10 years could be 11 years.
And of course, that's a new due diligence question in terms of purchasing a commercial property now is how far into the 10 years am I, or am I in the 10 years?
And that's part of the disclosure under the vendor statement. It'll be on the land tax certificate. It will say there's an extra certificate that specifies if the property has entered the regime, so you'll know that.
So, Julie, while you've got the microphone, are we seeing the new regime start to influence how commercial property transactions are structured and negotiated?
I would say no.
Thanks, Julie.
From a personal perspective, I feel like it's a little bit too early to tell. We're coming up to 2 years. One would hope that when we advise our clients about it, our advice is that good, that they don't ask questions about it. I'm not sure that that's right, but I don't get a lot of questions about it. We send out what it is if we're advising a client before they purchase the property, but we don't seem to see that used as a negotiating tool. And I also don't think that banks are really taking it into consideration at the moment. I guess from my perspective, my view would be as you get down the track a bit and it's towards the end of the 10-year period, that's when I think it will come into play, because you will have that new 1% tax. And I also think if you're financing that as a bank, you're going to be looking at cash flow, and that I would assume would be part of their lending criteria as well.
So we're a bit early in the process at the moment, but it's going to become more and more relevant as time ticks on and more properties have their triggering transactions. Thank you. Before I go to the scores, this is the part of the show where the audience get to ask truly random questions. Can I first ask if there have been any players at home that are accepting questions? None at all. Well, those who went back to sleep, no. That's fine. If anybody at home has a question, please let us know. Is there anybody in the room who has a question about Go?
How is the vacant use recorded? Does your accountant have to sign that and then send that to the ATL, the State Revenue Office? How's the use certified?
That's on the landowner. So there's you need to notify the SRO by the 15th of February in that year. So so that's the first step, I guess. The second step is when you get your assessment, if you notice it's wrong, you're on an obligation then obviously to make that notification then as well. And just in terms of the penalties, I guess, if you don't do it, that they can range from zero, I guess, if there's, it is a good faith mistake. 25% is probably the normal penalty tax, 50% if it's reckless, and then it can go up to 75 to 90% penalty tax on top of that if you're, deliberately concealed or, you've made, I guess, fraudulent representations and things like that.
So what's the scrutiny like of that self-assessment? Do they sort of just take it and say, they tick the box and, you've said what it is, or will they go through and be like, actually, no, that's not actually how it should be used?
I think if you're notifying that it's vacant, they will accept that on the face of it because they're getting their tax, additional tax. So I'm not sure that they question that.
The questions are when you say fellowship you have to pay because, and then there'll be lots of questions. Yeah.
And the other thing is, even if you think you're eligible to have an exemption, you still need to notify that it's vacant. But then you have to say, but we're claiming exemption for these spaces.
One of the big things is when you look at Marco from it earlier, that ignorance of this, like I haven't seen any ads on TV where the SRO is telling everybody about their responsibilities to report this, or full-page ads in the paper or anything like that. So sure, no, things so that it really is. It's self-reporting. The onus is on individuals to be aware of it and then identify when they might be under or over. And of course, there can be you have people who regularly use a holiday gas, but then go a European holiday and get an awful disease that puts you in hospital for a while. Just without thinking about it, they may tick under the required stay days. So it's pretty tough that you got to self-report. And you got to self-report not that you have to pay tax, but the property is vacant, that it's not being lived in essentially, I'll say on a full-time basis. There are time periods that apply, but you need to say it's so it's your holiday house. You need to say it's vacant, but not sit there and say, "Oh no, I don't have to pay because it's a holiday house." So maybe it's jolly.
And the one thing that I guess I recommend is evidence to substantiate that you are living there. Obviously, you've got, or you're staying there for the required period. You've got utility bills, you're using power, but show that you're physically in the region. So grocery receipts, they would say social media photos,
YouTube videos of the party.
the TikToks.
TikToks. What are that?
Anyway, I'm not really sure. Local spending, photos, things like that, just to make sure you've got enough evidence to, if you get questioned about it.
Yep.
I may not have been listening to you until the High Court decision result. I just wasn't clear. So today, with the heritage building, did the High Court decide that it was reasonable to tell you what is it's a heritage building didn't exist for they decided to
So what happened? By the time this got to the High Court, the High Court had reviewed the Court of Appeals decision and said that needed some further explanation. So the High Court referred back to the Court of Appeal, and then it was up to the parties to pursue the Court of Appeal and get an outcome. If you appreciate by that stage, how many years thereafter and costs and so on, it did actually find there was that final decision. And so parties decided to settle the matter and just leave it where it was at. So that's why we're now left with this High Court decision and this uncertainty about how the improvements are treated.
So the Court of Appeal had therefore the IRA Bank. and the tax office appealed it to the High Court, who then said it's uncertain and referred it back to the Court of Appeal. So that undermined the Court of Appeal's original finding.
In spiritual terms, yes. Russia, yes.
Potentially.
That's it.
I buy heritage property.
Well, here's
Well, there's lots of reasons not to buy a heritage property, but yeah.
Case the Court of Appeal, I've heard through University of Melbourne, the valuers there, all the faculty will be in design architecture, that the Court of Appeal are yet to issue their judgment. Currently the judgment is being written. Is there further work happening on this? I'm just asking Noe Uni right now, because that's what the students have been asking, that there's something further to come through with it yet.
So the understanding is that there is nothing further to come from the Court of Appeal. They will referred down by my court. Essentially, it's up to the parties to pursue further for the Court of Appeal, but they didn't pursue it any further. So it's just pretty much stayed with the High Court decision as to how improvements are to be considered.
So when the parties settled, was that a public, did the terms of the settlement, but they made public?
So no, the settlement is a private settlement agreement between the parties, and for, again, I'm not privy to the precise detail of it, but the settlement was effectively to end the matter at that point.
Would the taxable value have been determined in that settlement process? Would the parties have lived on a taxable value, or does it going back to the council, see top bill, whoever, to come up with that new taxable value? Who
So,
will determine that?
if the matter had continued, then the value, which originally was at a certain level, got reduced. The whole appeal objection process was really to try and get that tribunal reduced decision up to this new High Court theory of, disregarding the improvements, which would have lifted that value significantly. And no, that's, I guess, where the settlement, a compromise settlement occurred to avoid all that, revaluation of the property at high level. It pretty much ended when the High Court said, "Oh, we want this decision to be had." The Court of Appeal to review this decision, and it is the parties in pursuit further through the Court of Appeal to get the question answered, or re-answered. It pretty much ended in that position.
So really cases that the LGM just keep pure. And then, so it's not worth bringing up peers.
Well,
Because you've got no rested debt.
Well, this again is another issue. Yes, the valuer general will, as I tabbed earlier with the lawyer, the valuer is under instruction from process, I guess, or whoever might be determining. But they will look at the merits of the case, potentially what is at stake. I can't talk as to why they might pursue these matters at a certain level and ferocity, but it is very challenging, let's say, and hence why when we act for clients, we will review the merits of the case, the strength of the position. Invariably, there may well be 1, 2, or 3 years that have accumulated, because this is not something that happens over a 6-month period or over a 12-month period. These matters can drag on. So invariably, we're talking potentially 2 or 3 years of values that are under the appeal, which starts to make it a bit more financially, efficient and viable to run these matters. But again, these are pretty much reserved for high-value properties, and the advice that we would run that on.
I think it's fair to say too that the SRO don't have a lot of interest in getting a decision that's against them. And the fact that it resolved rather than then going back and continuing to push the barrow might suggest that they were a little concerned that they might not get the result they wanted. So the next person with a big enough bill who's willing to push it, you've got, it's not a signal that suggests that it's pointless. So it's just unfortunate that even at the High Court level, you didn't get the certainty of the outcome. You got the certainty that, yes, there's a question here that that saw it sent back to them to another court that didn't then get to determine the final question. But yeah, I think there's more to come in it.
Just on that point with Melbourne Uni closing off, I think it's caused issues with the up and coming valuers. Site value determination affected by heritage overlay. So I think it's causing a bit of unrest as to how valuers now deal with this decision in their practice. And yeah.
Well, Liz, you're right. I mean, as you appreciate, the Valuer General of Victoria contracts out these valuations and often provides guidelines as to how these valuers are to value these properties in these types of circumstances. And we are right now in the situation, it may well be the return values as of January 2026, that we will see how they are dealing with these matters. And so therefore, you will see it first in your rate notice that will get issued around August or September. If your site value is all of a sudden jumped up considerably, you can get a really good understanding as to what's happening there, and hence best to call Betsy.
Any other questions?
Just looking to the future, as you know, the state governor has rezoned areas around Malden, Armidale, Toorak, South Yarra stations. So let's say in theory I own a house to 100 metres from one of those stations. They're going to be up in value enormously of that rezone. Do you think that will mean that land tax will now, because now that this single level house on a block of land being rented out, but sudden there's plenty of apartments got, you think that's going to be a future concept issue?
Well, please be aware that a site value is assessed irrespective of what improvements are on there. And it's assessed according to the highest and best use of the land.
Yeah.
And fundamental to determining the highest and best use of the land is the planning controls. And so absolutely, a lot of the matters we're running these days involve planning consultants, because that is a question that I have as a valuer. I'm not an expert planner. And so one of the experts is part of the questions that Ric wrote mentioned earlier, is that a planning consultant is critical to understanding what that potentially means for that particular property. So
Quite active.
absolutely, that would lead to it's about market sentiment too. If developers are buying the property with the intent of building something high-rise or mid-rise, and that's reflected in the value of the land. So that's the evidence that's supporting that.
Well, that is the reason that, again, here in South Yarra and Armidale, we were the property for sale. Someone wrote, this is going to have 44 apartments on it, go for it. And the estate agent paid around and rubbed it off, and yeah, so it's alive, it's out there.
It's all bad news. Yep. Sorry, we've got time for one more question.
A very simple question, Julie, and you mentioned about the exemptions for the residential. Given that there is a rise in some granny flats as such, and that's the best use of a land we can build, how are they exempted as well, or are they captured being that residential making aware or making barriers that?
So do you mean are they exempted? Oh, yeah. Land tax or the bay?
Land tax as well, yeah, because it's the best use of land. You just put a granny flat on your two bedroom, 1 bedroom or something in your courtyard, and then you use it or not use in a door in a kitchen. Is that specifically accepted?
I guess that would depend largely.
do that principal place improvements.
Largely on whether it's separately rationed or not and separately assessed. But if it satisfied that if it wasn't being used and it was separately rated and separately assessed for land tax, then there probably would be the notification required.
Yeah.
One thing actually that I didn't mention, I'm a bit hesitant to say it, but there is actually an ability to claim 2 holiday home exemptions. So if you've got a husband and wife owning a principal place of residence and there's 2 holiday homes, there is an ability for one to claim each holiday home. That is scrutinised by the State Revenue Office for obvious reasons, but if you satisfy the criteria, which the 4 weeks in the year, they can have the ability to claim 2. One per person.
I think the High Court considered this at one stage, and I think the term was no bullshitting was so indicated. You do have to be careful. Nobody must pay these taxes, but there's some, the SRO, very good at at investigating because there's so much more information out there.
Just one quick question. Do they only, they only consider properties that are within Victoria? If you've got a holiday home in Queensland, they can't do a little bit.
Southern Victoria.
Yeah, so state will yeah, Upper Sun, West of Victoria, which actually is what most people are doing.
Or go to Adelaide by the sound of it. So, ladies and gentlemen, that brings us to a close right on 9 o'clock. Just finally, the scores on 600 points. Julie, well done, Julie. Thank you very much. Also on 600 points, Chris. Well done, Chris. And also on 600 points, Bargo. So you're all brilliant. You're all in the mint. And I want to thank all of you on the panel for what has been the driest, worst, most boring, but most crucially interesting topic. Thank you all for your expertise, your brilliance, and for your hard work. Thank you, everybody, for attending. I hope you learned something. And if you didn't, I hope you learned that you're really clever and you knew it all. Hopefully we'll see you. I actually don't have details of the next topic, but no doubt there will be some information coming out to you shortly, and we'll see you again then. Thanks for attending. Have a brilliant day, and see you all next time.